financial escape velocity. It's a term that gets thrown around a lot in the FIRE community. Financial independence, retire early.
Mhm.
It usually conjures up these images of a spreadsheet calculator, finally turning green, or a specific net worth number hitting your bank account,
Right, the magic number.
the magic number. But let me ask you a very specific, maybe a somewhat uncomfortable question. Is it actually possible to build a portfolio that yields 14% consistently month over month without completely, well, losing your shirt?
That is the golden question, isn't it? Can
Yeah.
you really get those double-digit returns without getting the double-digit ulcers that come with them?
Right, because usually when you see 14% yield, your scam detector just goes off.
Immediately.
You assume it's a trap or some kind of Ponzi scheme or just a really, really bad investment wrapped up in a shiny bow. But today we are doing something a little different.
Yeah, this is special.
Welcome to another Blueprint to Escape case study. We aren't doing a theoretical overview today. We have, a massive stack of documents here. Spreadsheets, trade logs, strategy notes for a real-world portfolio review.
And the context here is absolutely vital. Today is Sunday, January 18th, 2026. So we are not looking at historical backtests from 5 years ago. This isn't theory.
No?
We are looking at the Blueprint to Escape holdings right now, as in the actual positions held in January 2026, and maybe more importantly, the strategic battle plan for February.
This is Live Fire. Our mission today is to really dissect the decision-making process behind this high-yield income portfolio. We aren't just going to list off tickers. Anyone can look up a ticker symbol. We want to reverse engineer the psychology. Why did they sell a winner? How are they managing risk when the market, throws a tantrum?
And how do they define enough? That's a big one.
It is. It's about the psychology of the trade as much as it is about the math.
And frankly, the psychology is usually where people fail.
We've got a pretty good teaser for you as well. Later on, we are going to talk about a move that seems, well, completely counterintuitive to most traditional investors, selling an asset specifically because it made too much money.
A suffering from success problem. But it's a real problem for an income investor, believe it or not.
And we're going to talk about why worsification, and yes, that is a real word we're using today, is the enemy of the wealthy. So let's unpack this case study.
Let's get into it.
So we have to start with the rules of engagement. Section 1. The philosophy of the escape. Looking at the case study, the headline number is obviously the yield. But if you dig into the policy documents, the core objective isn't just make the biggest number possible.
No, not at all. And that is where people get burned. If you look at the blueprint documents, the hierarchy is explicit. Capital preservation is priority number 1. Total return is second.
Okay, hold on. Capital preservation first. With a
Yeah.
portfolio that's yielding 14%, that feels contradictory.
It does.
Usually, high yield implies high risk, which implies capital danger, not preservation.
It feels like a paradox, I agree. But here's the mechanism behind it. This isn't about treating the stock market like a slot machine or chasing a high score.
Right.
It's about generating sleep well at night income. The logic is simple. If you are chasing a 20 or 25% yield, but the underlying share price drops by 20% a year, what are you actually doing?
You're just getting your own principal back in monthly installments.
Exactly. You are just withdrawing from your own ATM and calling it a paycheck. And that isn't income. That's a slow liquidation of your assets.
I see.
So the Blueprint team, they define what they call a yield sweet spot. For a mild portfolio, they want 8 to 12%. For an aggressive one, which is where this portfolio definitely leans, they target 12 to 18%.
So 18% is the hard ceiling. Is that the line in the sand?
Generally, yes. It's the upper guardrail.
So what happens if they find a fund yielding, 30%? I see these advertised on the internet all the time. Generate 50% yield with this one crypto derivative option strategy.
That immediately triggers a red flag for what they call NAV erosion. That's net asset value erosion.
Okay.
When a fund yields significantly above that 18% range, the math, it just rarely works out over the long term. The fund essentially has to sell off its own underlying assets, its furniture, if you will, just to pay you that dividend.
That's cannibalization.
It is, and it's so insidious because you feel rich in the short term. The check hits your account every month. You feel great.
Right.
But 5 years later, you look at your balance and you have half the money you started with. You've literally eaten the golden goose.
So rule 1, stay under 18% to avoid eating the goose. Got it. Now, you mentioned a funny word earlier. Talk to me about worsification. This comes up in the risk management notes. It sounds like over-diversification.
It is exactly that. Conventional wisdom, the stuff you hear from standard financial advisors, says buy the whole haystack, own 500 stocks, own the world.
Right. Buy the S&P 500, buy everything and just, chill.
And look, that works for accumulation. But for this specific income strategy, the Blueprint team takes a view that's much more similar to, say, concentrated value investors.
Okay.
They believe there is a hard limit to how many truly good ideas you can find at any one time. So they cap the portfolio at roughly 23 to 25 holdings.
That seems incredibly low. 25 holdings, if one of them implodes, that is a massive hit to the portfolio.
It is, but here's their argument. They say that beyond 25, you aren't really reducing risk mathematically. You are just diluting your returns.
Oh, so?
Well, if you have 100 stocks and your best idea doubles, it barely moves the needle on your net worth, right?
True.
Worsification is the act of adding mediocre investments just for the sake of feeling safer.
It's safety theater. You are just buying things you don't really understand just to have more lines on your spreadsheet.
Precisely. But to your point about the risk what if one implodes, that is exactly why they have the 15% rule.
Okay, lay that out for me.
No single holding is allowed to exceed 15% of the total portfolio weight. That is the hard guardrail. So if a position goes to zero, which, let's be honest, with an ETF is highly, highly unlikely, but let's say it drops 50%.
Okay.
You are hurting, for sure, but you aren't wiped out. You live to fight another day.
It is like a compartmentalized ship. If one section floods, the whole Titanic doesn't sink.
Hopefully a bit better than the Titanic, but yes, that is the basic concept.
However, I am looking at the January 2026 snapshot right here, and I see a blatant violation of that very rule, but we will put a pin in that for just a second. I want to move to section 2. The January moves, this is where we see the strategy in action.
This is the rubber meeting the road.
What I found so fascinating about this month's review is that they aren't just buying, they are selling. And the first big move involves that too much profit paradox we tease. They sold their entire position in RPF. That's the RBC Preferred Share ETF.
Correct. They sold it all.
Walk me through this. RPF went up in price. Usually we high five when that happens. Why on earth did they cut it?
This really requires a shift in mindset from growth to income. You have to remember how yield is calculated. It's just a function of price. If you buy a share at $100 and it pays you $10 a year, that is a 10% yield.
Simple math, yeah.
Now imagine everyone rushes to buy that same stock. The price shoots up to $200. But it still only pays $10 a year. What is your yield now?
It's 5%.
Exactly. RPF appreciated so much in capital value that the effective yield dropped below their target threshold. It simply no longer served the function of the portfolio.
So in their eyes, it basically became dead equity.
In the context of an income portfolio, yes.
Yeah.
It was taking up valuable space that could be used by a harder-working, higher-yielding asset. So they exercised what I think is extreme discipline.
It must have been hard.
Oh, for sure. They sold it, they harvested that capital gain, and then they moved that cash into a more productive vehicle.
That is psychologically so difficult, though. Selling a winner feels wrong. You want to let it ride. You fall in love with the things that make you money.
It does. But in this blueprint, letting it ride actively reduces your monthly cash flow. You have to prune the garden. If a plant stops producing fruit, you have to replace it, even if it has really nice leaves.
Speaking of pruning, let's talk about the big tech shift. This is probably the most technical maneuver in the whole report. They sold GOGY, that's a Google covered call ETF, and at the same time, they are aggressively buying GOGL, the actual stock.
And this is such a critical distinction. It really highlights the difference between believing in a business and believing in a specific financial instrument.
Explain that difference.
Okay, so they are 100% bullish on Google, the company. We'll get into exactly why a bit later. But they realized they hated the instrument they were using to hold it. GOGY is a single stock, leveraged, covered call ETF.
That is a mouthful. Say that again. Single stock, leveraged, covered call.
Right. It means you are taking the volatility of one single company, Google, and you are amplifying it with leverage. Then you are writing options against it to generate that high yield. The problem is, when you add leverage to a single stock, you are taking volatility too far.
Because if Google has just a bad week, the fund has a catastrophic week.
And even more importantly, something called leverage decay kicks in. If the stock drops significantly, it takes an absolutely massive rally just to get back to even. They decided their risk-to-reward ratio was just broken.
Okay.
They wanted the exposure to Google's growth, but they didn't want the structural risk of that specific leveraged ETF.
So they're buying the plain vanilla stock GOGL for the growth component, but they still need the income. So where did the money from the GOGY sale go?
It went into Evolve ECI-SHY.
ECI, what's the thesis there? Why that one?
Well, it fits their philosophy of risk mitigation much, much better. ECI is also a covered call strategy, so it generates that double-digit yield they need. But, and this is the key difference, it holds a basket of more than 10 different stocks.
So they swapped a unicycle for a bus.
That is a perfect analogy. The unicycle GOI might be faster and more exciting, but if you hit one little bump, you are face planting.
Right.
The bus, ECI-SHY, it absorbs the bumps because the risk is diluted across 10 different companies. It stabilizes the income stream. It also acts as a really nice companion to their other holding, Harvest HHIC.
Got it. I also noticed they did some housekeeping with a smaller ticker called TRIN. This seemed like a smaller move, but I'm curious.
It was small, but it's really important. TRIN is a business development company, a BDC. They sold it because they realized they were accidental victims of the fund-to-funds trap.
Which is what exactly?
It's when they looked under the hood of their other ETFs, specifically PBDC and the INCM ETF, and they realized those funds already own TRIN.
Ah, so they were double dipping without even realizing it.
Exactly. They were holding it directly, and then they were also paying fees on the ETFs to hold it indirectly for them. It's just redundant. So they cut it to clean up the lines. It is a great lesson for you listening right now. Do you actually know what is inside your ETFs?
Right.
Or are you just buying the label on the tin? You might be paying double fees for the exact same asset.
That brings us perfectly to Section 3, the scoreboard.
Sure.
Let's look at the portfolio snapshot as of mid-January 2026. Give me the high-level stats.
Okay, so as we sit here today, the total portfolio yield is approximately 14%. Structurally, it's about an 80-20 split. 80% is in Canadian assets, mostly income-focused inside tax-free savings accounts, or TFSA, and cash accounts.
Okay.
The other 20% is in U.S. dollar assets, a mix of growth and income, and that's tucked inside an RRSP.
Let's tackle the Canadian side first. We mentioned a rule breaker earlier, HDIV.
Yes, the elephant in the room.
It is sitting at a 16% weight. The rule is 15%. Why didn't they trim it back? I mean, are they just getting sloppy?
No, not sloppy, just convicted. The notes we have explicitly state they view HDIV as, and I'm quoting here, one of the greatest ETFs in Canada.
High praise.
Very. It uses a modest amount of leverage, about 25%, to boost the yield across a diversified basket of other ETFs. Because they trust the management and the structure so implicitly, they basically gave it a pass.
So the rules are more like guidelines then?
Strong opinions, loosely held, as they say. But in this case, the opinion is very tightly held. They're actually reinvesting the dividends back into it, which is making it more overweight.
So that dangerous?
Potentially. But, Warren Buffett would say, put all your eggs in one basket and watch that basket very closely. They're watching HDIV very, very closely.
All right, now I have to ask about this. I'm looking at the yield column for HHIS and HBTE. The source material says 26% yield. Is that a typo? Or are these things actually paying out 26%?
It is not a typo. That is the annualized distribution yield.
Yeah.
But, and this is a massive, massive but, you have to look at the total return, not just the yield.
And I see right here that HBTE is labeled a problem child.
HBTE is the headache of the portfolio right now. It's currently about 8% of the holdings, but the goal, the explicit goal, is to get it under 5.
But why? If it pays 26%, I'd think I'd want more of it.
Because the capital value is bleeding. The underlying stocks in HBTE include companies like Iron and Hood, crypto miners, volatile trading platforms. These stocks have a beta above 3.
Okay, we need to stop and explain beta. We hear financial types use this word all the time to sound smart, but what does a beta of 3 actually mean for my wallet on a Tuesday morning?
Okay, think of beta as a volatility multiplier. The overall market, let's say the S&P 500, has a beta of 1. If the market goes up 1%, a stock with a beta of 1 goes up 1%. Boring, predictable.
Okay, makes sense.
A beta of 3 means if the market moves 1%, this stock moves 3%.
Oh, so if the market have a bad day and drops, say, 2%.
Your stock drops 6%, it crashes 3 times harder. And when you are running an income strategy where you sell options to generate that yield, that kind of chaotic movement is an absolute nightmare.
Wow.
It just makes it very, very hard to capture value. The Blueprint team, They feel a little trapped in HBTE right now. They're sitting on a capital loss.
That they can't just sell it without locking in that loss.
Exactly. So they are choosing to be patient. They are waiting for a rally, a dead cat bounce, so to speak, to start trimming the position slowly. They call it rolling the position. They'll collect that massive distribution while they wait for the exit door to open up a bit.
That sounds like trying to disarm a bomb while it's ticking.
It's a little bit like that. It really highlights the danger of just chasing yield. You might get in for the 26%, but getting out with your shirt on is the hard part.
Let's flip over to the brighter side. The US dollar portfolio, the growth engine, inside the RSP. We talked about Google earlier. UOGL is the top holding here at a 3% weight.
And this is where that competence rule really comes in. The team notes mentioned they have actually worked for or with Google in the past. They aren't just reading analyst reports. They understand the plumbing of the business from the inside.
Invest in what you know, the old Peter Lynch adage.
Precisely. And their bull case is fascinating. It isn't just about search. I mean, everyone knows about search. They are looking at Waymo.
The self-driving cars.
Yes, 20+ million real-world miles driven. They believe Waymo is fundamentally winning the autonomous race. They view Google as a future utility company for the entire AI age.
Interesting.
So while they use the Canadian ETFs to pay the bills today, they use Google to ensure they don't go broke from inflation in 10 years.
So it's a barbell strategy. You've got this dangerous high-yield income on one side and then massive growth tech on the other.
It is balanced, or at least that is the intent. They also hold other assets in there, like QQQI, NIHI, and GPIQ, just to round out the exposure.
Okay, so that is the State of the Union for January. But a blueprint is about looking forward. Section 4, the plan for February. What is on the radar?
Geographic arbitrage. They're calling this the nomad advantage.
I love this concept. This is where their lifestyle actually informs their money decisions.
It does. The team spends about 6 months of every year living in Brazil and other parts of Latin America. So because they are physically there, on the ground, they are seeing things that Wall Street might miss.
Yeah, they aren't just looking at spreadsheets, they're looking at construction cranes.
Yeah, they're seeing the packed shopping malls, the fintech adoption, the consumer sentiment on the street. Because of this on-the-ground intel, they are aggressively looking at Brazilian tickers like EWZ and Latin American funds like ILF.
It is pure Peter Lynch-style investing. Buy what you see.
It is. They believe the market is pricing Brazil based on old political fears, while the reality on the ground is an economic boom. So they plan to reduce some other holdings. It looks like they're likely trimming a position called WHMI to fund this expansion.
But are they just going all in on emerging markets? That sounds, well, incredibly volatile.
No, and that is the discipline coming back in. They are pairing this aggressive Latin American play with what they call a defensive rotation. They are looking to add boring, stable sectors, healthcare, REITs, private credit.
Fortress assets.
Exactly. They are currently eyeing a ticker called MRL in Canada. The goal is to build a wall that can withstand a recession while that Brazilian growth hopefully kicks in.
Smart. So clean up the problem child HBTE, expand into Brazil where you have a clear information edge, and then fortify the castle with defensive sectors.
That is the February battle plan in a nutshell.
This brings us to the bigger picture, Section 5, life design. Because let's be honest, nobody grinds over spreadsheets of beta coefficients just for the fun of it.
I actually do.
Okay, you do. But for normal people, the money is a tool. We're talking about the nomadic expat structure. How does this portfolio actually facilitate a certain kind of life?
It is all about tax efficiency and location independence. Their structure is really clever. They keep their home base in Canada for legal and tax reasons, but their lifestyle is completely global.
And the accounts mirror that structure.
Yes. They use the RRSP for their U.S. assets. Why? Because of the tax treaty between the U.S. and Canada. The U.S. doesn't withhold taxes on dividends paid inside a recognized retirement account like the RRSP. So you get the full growth of Google and the full income from the U.S. funds, untaxed at the source.
And the TFSA.
That is the income hose.
Yeah.
It's tax-free income generated in Canada to fund their spending money for when they're in Brazil.
So for our listeners in the U.S., what is the parallel here? What's the equivalent?
It's very similar to the Roth IRA versus a traditional IRA debate. You want your high-growth assets where they won't be taxed on the capital gains down the road, and you want your income assets where you can access the cash flow as efficiently as possible.
Right.
The principle is simple. Shield your money from the tax man so you can spend it on your life.
And there's a philosophical layer here, too. I noticed the case study material mentions Stoicism. Invest with conviction, not emotion.
It sounds so cliche, but it is the hardest thing in the world to actually do. When HBPE drops 10%, do you panic sell?
Or when RPF goes way up, do you get greedy and hold on for too long?
Exactly. A stoic investor sticks to the blueprint, to the rules.
They also make a pretty good point about age, income versus growth.
This is crucial. If you are 25 years old listening to this 14% yield portfolio might actually be a terrible idea for you.
Why is that?
Because you are in the accumulation phase. You don't need monthly cash flow. You presumably have a job. You need capital multiplication. You should be heavier on the Googles of the world and much lighter on the covered calls.
But if you are 45, 50, or trying to retire early,
Then the whole game changes. You shift from make the pile bigger to make the pile pay me every month. And the blueprint portfolio is designed entirely for the latter. It buys freedom. Specifically, the freedom to be researching Brazilian ETFs from a beach in Rio.
which is a pretty nice visual to have in your head. So let's wrap this up. What are the key takeaways from this case study? If I'm listening to this and I want to try to replicate some of the success, what are the commandments?
Okay, first, don't be greedy. Take your profits when the math changes like they did with RPF. If the yield drops, the asset has to go. It's just business.
Okay.
Second, don't overlap. Sell your redundancy. If you own the ETF, don't also buy the stocks inside it. You are just paying double fees for no reason.
Right.
Third, know what you own. Whether that's Google's cloud margins or just the vibe on the street in Sao Paulo, you need a competence edge, an information advantage.
And fourth?
Respect the beta. The HBTE situation is a huge warning. High yield often comes with high volatility. If you don't respect that fire, you will absolutely get burned.
Respect the beta. I might just put that on a t-shirt. So here is the provocative question we want to leave you with today. We have looked at the numbers. We have verified the 13% yield is real, albeit with its own risks. If your portfolio generated a consistent 14% yield starting tomorrow, reliable monthly cash hitting your account, how would your daily life actually change?
Yeah. Would you still be driving to that same office? Would you still be living in the same city?
Or would you be researching your next investment from a cafe in Lisbon or, like we said, a beach in Rio? It is a serious question. The math is possible. The real question is, do you have the blueprint to execute it?
And do you have the discipline to stick to it when the market gets shaky?
We really want to hear from you. Please post your comments or questions below. Tell us, are you team growth or are you team income? And hey, if you are a nomad or aspiring to be one, let us know how you handle your portfolio on the road.
And don't forget to subscribe. We have a lot more content coming about financial independence, passive income, early retirement, and of course, nomadic life design.
This has been another case study. We will see you in the next one.